Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. Again, I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And this is the place where we meet every Tuesday to discuss all the different skills and insights that you need to be master to have in order to invest in passive real estate. Now, so if you haven't done so already, make sure to check out PassiveInvestingWithWhitney.com. There you can get access to not only our weekly masterclass classes, which are based on education, what's happening in the news, but also our skills boot camps that we do one time a month. And you can get access to our deals here at PassiveInvesting.com. And if you want, you can hop on the phone with me one-on-one and we can discuss how passive real estate helps you meet your investing goals. And we can do a little bit of strategizing there. So again, visit PassiveInvestingWithWhitney.com. Now, today we're going to talk about how savvy real estate investors thrive in passive real estate despite high interest rates. Now, I know we are recording this in December 2024. Everybody's been excited. We've already had 2 rate cuts from the Fed. We're looking at a possible 3rd rate cut here pretty soon in the next couple of weeks. However, I think we need to level set what all this truly means, and if those rate cuts are really going to trickle down to mortgage interest rates, which is everybody's crossing their fingers that they will. But before we do that, again, this Passive Investing Made Simple show is your place to be. If you want to turn your income, your active income or your income from your business into long-term passive income and wealth. And maybe you've tried investing in passive real estate before, but just going to get quite comfortable making your first or next investment. Maybe you actually invested in a deal before and you found out, oops, I made a mistake. I kind of leapt in before I understood all the ins and outs. Or simply you're just here because you want to sharpen your skills. If that's you, you're in the right place. Now, a little bit about me. I have partnered in over 800 million in active real estate. It's 6,500 residential units, 15 express car washes, 2,200 self-storage units. I've flipped over 5 million in assets. So I've done all the active stuff. But what got me freedom and choice on how I spend my time, getting to do what I love here, which you see me and my crazy crew here on one of our last adventures, is actually how I took all of that active income and moved it into passive investments to where I get a better leverage on how I trade my time for dollars or don't actually trade my time for dollars. And that's what I love doing here is helping investors, understand the power of passive real estate and how you can craft your own portfolio based on your goals, your risk, and your timeline. Now, that's what I do here as my role at PassiveInvesting.com, but also I coach people one-on-one at ashwealth.com. I also have the book published with Bigger Pockets, Money for Tomorrow, How to Build and Protect Generational Wealth, and I've done a slew of other things. Now, again, all of these things, all of this portfolio growth has pointed to one result. And this is probably a result that you're after too. And is that how do you get 100% control and choice on how you spend your time? And that's what I love teaching you here how to do. And we can actually help you do that here with our investments at PassiveInvesting.com. Whether it's investing in the bottom part of the capital stack in our real estate debt funds, or towards the upper ends of the capital stack in our equity investments, we can help you navigate all layers of the capital stack and build out a well-rounded portfolio here at PassiveInvesting.com. So again, make sure to check out PassiveInvestingWithWhitney.com and get all of your freebies there. Now, before we dive into today's topic, I always have to put out the disclaimer. None of this is financial advice, legal advice, or tax advice. So make sure to take all this back to your investment team before making any investment decision. All right, so as a savvy investor, how do you survive despite what's happening with interest rates? Okay, and I think this has been, especially over the past couple years, investors have been like, hey, interest rates are high. I know what to do. I'm going to kind of sit on the sidelines, maybe do more debt deals. I'm going to wait for interest rates to come down before I start investing. But how do you know when to get off the sidelines? How do you know when to start shifting your investments from debt to equity? How do you know when is the right time and avoid catching that falling knife? Well, let's understand why it's super important to understand how high interest rates actually can be an opportunity to invest and not necessarily a mandate for you to go into a flight to safety as far as your investments or to keep on the sidelines. And that is because some of the best real estate and more successful real estate deals were actually born in a high interest rate market. Why? Because you get a lot of competitors out of the market. They simply can't survive. And today we're going to show you what those opportunities are so you can continue to grow and scale your portfolio over the next few months. Now, the first thing that we have to fully understand here is what are two cycles? Okay, I've been talking about this a lot the past couple of months here, on the Passive Investing Made Simple show. And it's just something that we really need, as passive investors, we really need to keep this in front of us is like, what is the debt cycle considerations? Where are we in this debt cycle? And where are we in the actual market cycle? Let's tackle the debt cycle first. Okay, so and here's the thing, I can speak globally to what's happening in the United States according to headlines, according to what economists are saying, but real estate is hyper local. So local markets are going to move out of lockstep for what's happening globally on the national level. Now, in most markets, we're right here, somewhere in this part of the debt cycle, probably less credit being available to like more the recessionary part of the market. Okay. So in some markets, we're starting to see a little bit of credit expansion happen. Banks are getting off the sidelines. They're starting to lend again on certain assets. Some assets like single family residential real estate wasn't impacted really hardly at all. Okay, there was a little bit of credit tightening, but not too much. Not like what we saw in the multifamily markets or even the self-storage markets. Okay, so we're in most parts of the credit cycle, we're probably kind of like here towards the bottom and maybe even peeking out of the expansion side. Okay, so what your first step on how to survive interest rate volatility, especially in this nebulous time, like, are we through recovery? Are we getting in the expansion phase? What do I do? Okay, the first thing is make sure that you're partnering with the right teams. So you're looking for operators that have a proven track record of navigating either real estate or business or real estate businesses through different types of interest rate environments. You want to make sure that their deals that they're putting out are actually stress tested based on assumptions, meaning that they're continuing to look at the different scenarios on whether cap rates are going to continue to expand and get worse in that market, or whether they're going to actually compress and the market's going to get better. Because remember, we don't know if we're at the bottom and coming out. Okay, you could still be getting into a deal where that cap rate is going to continue to expand, meaning the market might get slightly worse before it gets better. All right, so you want to make sure that any deal you go into, especially an equity deal, that the operator is stress testing all of their numbers still and not just giving you rose-colored glasses projections, that they're actually looking at all the metrics and giving you a set of numbers to take a look at. Hey, this is what could happen if we haven't timed the market perfectly and things are going to get a little bit worse before they get better. All right. Now, as always, we always want to partner with an operator that has given us conservative projections for occupancy and growth. Okay, that is just something that we learned, coming out of COVID. But we want to make sure that we're holding on to those. We haven't lost sight of conservative projections as we move forward, because if we have an experienced operator that knows how to navigate business and real estate, if they've stress tested their numbers and they're being really conservative with their numbers, we're about 75 to 80% way there on getting a good deal in our portfolio. All right, so we're only 75 or 80% of the way there. What are some of those landmines we could still step on? Well, first of all, Is that operator still over leveraging on assets? Okay. Without having any sort of hedging strategies, meaning maybe they're still using floating rate debt, but do they have the debt for at least the term of the business plan? Is it locked for that at least that long? Do they have ways to get interest rate caps on there? We want to make sure that we have hedged not only our bets, but we are hedging the downside as well. All right. Red flags too. Is there just an unrealistic rent growth assumption happening? In some markets, there's a heavy competition. I mean, some markets have a lot of hypersupply in them. Okay, so is an operator saying that they expect 5% year-over-year rent growth in a market where there's huge amounts of hypersupply that still needs to be absorbed? Okay, that may not be a good assumption for that particular deal. And then also a red flag. This is just blanket, across the board, any market, any operator. If you're getting poor communication, okay, not only on the investment upfront in general, but also through the hold in the investment, okay, that's a red flag, okay? We want to stay away from these known red flags as early as possible. All right, step number 2, how to survive interest rate volatility environments. Again, these are tools, because we don't know if we're at the bottom coming out or if we still have a ways to go before we come out, is again, to make sure to evaluate your deals carefully. All right. So this isn't just about the actual deal itself, but I challenge you to look across the different areas of the capital stack as well. Now, I need to pull these apart because this is a pretty big concept to lean into. So let's actually look at what should we be asking in each layer of the capital stack? And then we're going to get into how do we diversify across the capital stack? Well, if we're looking at a capital stack is all the layers of money that could possibly go into a deal. Okay, so we could have our senior debt, like our bank loan. Maybe there's an additional line of debt on the property. Maybe there's a line of credit or a secondary note that's been brought into play. And then we flip into the equity layers. That's generally where our limited partners get involved. And they are partnering with the general partners on the deal to take advantage of the upside of the deal. So the debt layers are simply different layers of being the bank. The equity layers are going to be the partners who are trying to create value in the asset and are going to split cash flow and profits. Now, here's the thing. I argue that you should be diversified across all layers of the capital stack in order to create a smooth and recession resilient portfolio. But let's just take each individual layer and what questions you should be asking. So if you're going to invest in, say, like a senior debt layer, right? Now, this isn't extensive due diligence. I have other videos on our passiveinvesting.com YouTube channel, okay, that go into each how to perform due diligence on each of these layers. But say you wanted to diversify into the senior debt level here towards the end of the year, the beginning of 2025. We want to make sure that we're getting into assets that have good loan to value ratios, that there are interest rate hedges in place for floating debt, and that they have a historical default rate in the asset class that is super incredibly low. Now, for senior debt default rates, we're probably like around 1 to 3%, still industry standard. We have our PIC real estate debt fund where we target 0%. Are we at 0? No, we've had 3 defaults in that particular fund, but it gives us a 0.2% default rate when the industry standard is closer to 1 to 3%. All right. What are some quick questions to, high level vetting of like the next layer? Okay. Like a promissory note layer, that mezzanine debt. We have our PIC 29 North promissory note. Questions that I would ask: is the mezzanine position well cushioned between the senior debt and the equity? All right. Is the senior debt pretty low, say like 60 to 65% loan to value, and then you've got another 20, 25% of common equity class right behind you, okay? What you don't want to do is to go into a promissory note position where the senior debt is, say, 80 to 85%, and there's only like 5 or 10% of common equity class right behind you. Okay, you don't have much cushion. That's not much of a protection. Okay, that makes the little top of the capital stack super tiny and the base of it super big. We want to make sure that we're in the lower tier of the capital. What is the borrow operator's track record? Okay, do they have an experience with this type of debt? Are cash flows strong enough to cover the debt service payments to the senior debt, as well as build up cash flow for the mezzanine debt position, whether it's being distributed monthly, quarterly, or if it's going to come at the end of the note cycle? All right, and again, these aren't fully exhaustive due diligence questions, but it's just enough to give you a flavor. Um, for each one of these layers. And then you can get into the preferred equity class. That's another thing in this market, that is still pretty hot, a way to get invested into passive real estate without having to take chances on a common equity position quite yet. And that is does the preferred equity structure guarantee a fixed return? Okay, is that something that you're getting paid out now, or going to get paid out at the end whenever that property repositions? And is that preferred equity aligned with is the operator aligned with the investor's interests? So if they bring in preferred equity, or if they close the deal with preferred equity, is everybody in alignment on how everybody makes money? Okay, it's not that we want one team to win and one team to lose, like limited partners win, general partners lose. We want everybody to be able to come together in a business plan where we all make money together and we're incentivized to do so. All right, so we've got our operator. We have looked at that we need to do due diligence on our deals. Okay, that's just standard across the board for any investment. But in order to survive high interest rate volatility, we also need to look at what the market is giving us. So let the market be the guide on what you're investing in. So I have pictured here, if you're watching our YouTube video, different phases of a market cycle when it comes to business and real estate. And I would argue for the most part, we are either in phase 4 recession. Now, we may not have actually called that. You may not have seen anybody in the news call a recession, but we definitely know in a lot of our markets, there's a lot of hypersupply, increased vacancy, and more competition. All right. And so that's going to drive down pricing, credit's being sucked out of the cycle. So the banks are, been sitting on the sideline waiting for the right opportunity to lend. In a lot of our markets in the Southeast, we're starting to see the banks come back and start lending on some projects, which indicates that maybe vacancy has kind of hit the bottom and we're starting to see that absorption and we're moving through the recovery, early parts of the recovery phase. Here's the thing, you can make money in any parts of the market cycle by remembering that if you're in the hypersupply recession part of the market cycles, lean your portfolio, look for deals that are more debt or debt-like structures, like what we just saw in our previous slide, that we're looking at, senior debt, mezzanine debt, or preferred equity positions. And then when we're in our growth and recovery phases, our recovery and expansion phases, that we're looking more at the equity opportunities that are coming on the horizon. Now, just to call it out individually, growth and expansion, common equity is great for the upside. During peak hypersupply, preferred equity and mezzanine debt is great for stability. In the contraction recessionary part, senior debt and preferred equity for risk mitigation is amazing. And then in the recovery part, this is where we don't know if we're in recovery until probably 6 months later. And then we can go, oh yeah, back in January, we were in recovery. Okay, but this is a great time to look at safe value add opportunities, mezzanine debt, for that little bit of rebound potential. Okay, the key point here is high interest rate environments call for strategic shifts towards debt and preferred equity. Okay, High interest rate environments call for strategic shifts towards debt and preferred equity. So, if you are an investor sitting here in December 2024 looking for the perfect equity deal to harvest some passive losses before the end of the year, it might be hard pressed to find because that's not the phase of the market we're in. So, look at what the market's giving you. All right. Step number 4, build that resilient portfolio. We're going to bring it back to our different layers of the capital stack. So we want to diversify across asset classes, operators, markets, and most importantly, deals. And I would say deal types across the different layers of the equity stack. Right? Diversifying into debt and debt-like structures can anchor your portfolio, offering stability and predictable returns while the equity markets adjust. So I promised you guys when we did this webinar that I would kind of give you a little bit of a crystal ball, at least my version of the crystal ball, on what we could be looking for next in a high interest rate environment. So I think we would all agree that we're not entirely clear if which part of the trough that we're through. Are we still heading down into a recession? Have we actually had that soft landing and we're starting to pull up? Okay. Again, we really don't know, but we can say for certain that we're getting these interest rate cuts. And every economist, when I was researching for this particular presentation, every economist agrees that we're probably going to land with mortgage rates, especially in the multifamily sector, at around 5.8 to 6.2%. So the days of 4%, 3%, 2% interest rates are gone for right now. Okay. So that does leave a a huge gap to fill because there's an increased demand for private capital to fill this funding gap. Right? So there's an opportunity for investors to come in and get a really nice debt-like return, you know, in this interest rate environment while interest rates still stay a little bit higher than we originally thought they were going to stay. Now, for the next 12 to 24 months, I think, according to everybody that I research, market volatility will continue. Will it be as erratic as we've seen in the past 24 months? All signs point to no. But in that case, I think, again, investors solving senior debt issues, coming in and solving mezzanine and promissory note issues, and then coming in and looking at preferred equity positions, I think those are all still going to be very viable strategies for the near future. Why is that? It's because banks are going to lend at a higher percent, say 6%. So general partners are going to want to get a lower loan to value and fill that other layer with a different type of debt position. So this means as a limited partner, you need to stay aligned with the market dynamics so you can position your portfolio for success. All right, we've covered a lot of ground today, right? Understanding how to navigate high interest rate market environments is not for the weak of heart, for sure. So how can we put a pretty bow on top and leave you with some actionable to-do steps? Remember, high rates don't have to mean high stress. So make sure you, as a limited partner, you're evaluating the deal, you're evaluating the operator, you're making sure your investments align with the market cycle and in the debt cycle, and that you're building a balanced portfolio to protect and grow your wealth. All right, guys, if you're here live, don't go anywhere. We're about to start our Ask Me Anything part of the show. All right, guys. If you're here live, I would love for you to go to the Q&A box, drop in your questions. Let me know what you love, what you would love to see. And let's take a few minutes here and get your questions all ironed out. It can be related to high interest rates, or it can be related to anything else passive real estate investing. All right, and we can either drop them in the Q&A box or the chat box. Either way, they'll get to me. If we don't have any questions, I'll just hang out here for a couple more minutes, make sure nothing pops into anybody's mind. As always, I always appreciate you guys taking time out of your day, not only to invest in yourself, but well, not only to spend here with me, but also to invest in yourself. If this is if you guys need to take off for the remainder of the day, I just thank you for joining me and have a happy holidays. We are actually going to take December 24th off, and we will see you back on December 31st. All right. No questions to come in. Okay, perfect. You caught me just in time. Okay, questions are coming in. Okay, I'm not going to go anywhere, guys. Please elaborate on the benefit of the private market, although interest rates are dropping. Okay, so even though so the there's still an arbitrage to play here. So if you notice, interest rates are dropping. Okay, now a lot of private equity groups are not going to drop what they may, like the interest rate. Like I'll just call ours out as an example. So in our PIC real estate debt fund, we are, for investments of $25,000, it's 6%. For investments of $1 million, it's 10% preferred return. We're not going to alter that. We've already baked that in. We've already did forward projections. It's not like as interest rates drop, we are going to drop our preferred rate that we pay for our investors. Okay, but I've had to answer this question a lot in the past, the early parts of this year. People are like, well, if I have 25K and I invested with you, I get 5% in the bank and I get 6% with you. So why would I do that and lock it up? Or not even lock it up, but just like, why would I do that? Like, I can see it in the bank. I can log in. I feel all warm and fuzzy, like my money is in the bank. Well, but as interest rates drop, that's impacting you in the market. Your savings account probably is closer to 3.5% now. Okay. Now, as interest rates drop, what they're trying to do, what the Fed's trying to do is get money off the sideline and get the economy going again, restart the economic engine. Okay. So, but we have to balance that out to where we are in the market cycle. Okay. So debt cycles and market cycles, there's a nice overlap, but it's not 100%. So multifamily hasn't 100% bounced back yet. So there's still a nice arbitrage here to where you could get your money out of the bank, have it earn a nice return. Oftentimes double or even triple what you would be making in the bank and put it in a nice, safe debt-like position. Whereas if we rewound 4 years ago, in order to get a 9%, 10% preferred return, you would have had to gone into an equity investment, higher risk, higher reward. Okay, now you can go into a debt investment and play a little bit of arbitrage. And it's still needed in the environment. There are plenty of operators that are underfunded on their assets. Okay, so this is a nice little arbitrage where somebody and the private investors can come into the lower tiers of the capital stack and get a nice cushioned return. So we have a promissory note that's open. Our investors can come in and get 12% preferred return on their investment and be in a debt tier layer. Okay. So that's a unique opportunity that just 2 years ago really didn't exist for investors. And it's because of what we're seeing in the environment where we're at in the debt cycle. What is a safe length for a bridge loan in this environment? Safe is all relative. And it depends when we talk bridge loan, it depends on what asset class. So single family, we play in the area of single family fix and flip loans. That's for our real estate debt fund. That's what we love funding. And we're tend to be in the 6 to 9 month timeline with our loans. That's a realistic position for a fix and flipper to come in and execute their business plan and get the property repositioned, either sell it or exit it out to another loan, a carry out loan. Now, if I had a multifamily building, probably not going to happen in 6 to 9 months. That's probably going to take 2 to 3 years. Is that safe for a bridge loan? I don't know. Okay, shorter time period, or excuse me, longer time period. So I have more risk to mitigate. So how do I mitigate that risk? I would want to, if I'm the operator, I would try to get the interest only payment period for as long as I possibly could. That way I can maintain my cash flow. So if my business plan is going to take me 2 years, I might get a 3-year interest only period on it. If it's going to take me 5 years, I might try to get an interest only for like 7 years on the loan, give myself a little bit of breathing room, at least for the term in the business plan, if not a little bit longer, because things happen. We've seen that. Also on the interest only, if it's adjustable rate, I want to see if I can get that rate locked for a period, maybe 3 years, and then have some built-in extensions to the loan, and then purchase an interest rate cap. That way, when it does start floating, it can't go above a certain interest rate. All right. So there are ways to mitigate that risk. Now, here's the question. This is where operators got in trouble, is that they used a bridge loan on an asset, and that quite honestly, in order to like juice the cash flow returns. And so meaning that the type of loan that was being used on that business plan and the asset was a bit mismatched. Okay, that's where people got in trouble. I think operators have learned that lesson now, largely. They should have. Okay, so you could expect to see moving forward a better match of the actual loan type to the actual business plan of the property. Okay, but fast forward like 10 years in the next part of the business cycle, I mean, will people have recency bias and have forgotten that lesson? I don't know. So this is something I always encourage anybody that I work with, write down all of your investing decisions ahead of time. Okay. Kind of like that, your due diligence checklist, but I call them your predetermined investment decision. So if you're nervous about having a property that has a bridge loan on it, okay, so either invest in things that don't have bridge loans, or invest in, if it does have a bridge loan, what are the things that you want to see, risk mitigation plan in place to kind of hedge your bets. How do you feel about projects using tax abatements to drive NOI increases? Tax abatements, that's a whole other strategy. We don't do it here at passiveinvesting.com, but just, having, being familiar with them. Tax abatements can be good when they're used properly. Like anything, you can have a tax abatement and it not be used properly, and a tax abatement that can be used properly. Yeah, somebody said, thank you for all your do. My pleasure. Happy to help. So if you're getting tax abatement, because usually in trade for a tax abatement, you have to set aside a certain portion of the housing to be affordable housing. And so you want to, if you have a high-end luxury complex and then you set aside 20% of your housing for, clients that or tenants that are just like 10% above the poverty line, that's kind of oil and water that doesn't really mix. So you want to make sure that it's paired with the right strategy. Do investors risk missing out on maximum asset appreciation due to the fact rents can't be increased adequately with the market conditions? Possibly. But my gather is if the operator should have done their due diligence. They should have stress tested that to say, hey, if we just bought this outright and could push the NOI as much as possible, and this is where the cap rate we're predicting it to go to in this market environment, and this is what we anticipate our future price range is, versus eliminating a line item, a very large line item. Because remember, you can get NOI increase by increasing income or decreasing expenses. You can get at it both ways. Okay. So I would argue is the simple answer is not necessarily, but the operator should have calculated it both ways to see which was going to be a bigger impact. And here's the thing, guys. If an operator can buy a building, say like a class B-ish, B- building, set aside a portion of it for low income type housing, get a tax abatement, and not have to do a rehab on those, okay, now you saved a lot of expense. Okay, they've eliminated line item, part of the line item for taxes, abated part or all. They've now don't have to do as much capital expenditure on those units. And so they might be able to get a good valuation for that. And here's the thing. If the next person buys it and say the tax abatement's only for 25 years, maybe the next person buys it and now the abatement has expired, and that person, they can now rehab the whole building and push value on it that way. So there's multiple ways to kind of skin a cat, and I hate to use that analogy, but that's essentially what it is. But again, you want to make sure it goes back to, does the abatement actually match the business plan for the property? Is it a good match? Okay, like tax abatements on a luxury property, which I've seen one, I'm like, ooh, that's how are you gonna figure that out? Like, do those tenants mix together well on the same property? Awesome. Guys, if you have any other questions, drop in the chat box. I'll hang out here another minute. You guys have some great questions as always. Otherwise, have a wonderful Merry Christmas, Happy Hanukkah, Kwanzaa, whatever holiday you celebrate. Have an amazing end of the year with your family. Yeah, you're very welcome. And as always, if there's a topic you would like to see me cover, please let me know. I am always open to feedback on any of the topics we cover, to make them better and more impactful for you. Otherwise, everybody take care, and we will see you, not in the new year, but on December 31st. Take care, guys.